Hello, I'm David Jones and I'm doing these videos in conjunction with Trading 212. We thought we'd try and do some videos about trading that were maybe a little bit different to the ones you're used to seeing. I'm sure if you've had a look out there that there's plenty of videos about trading tactics, there's lots of stuff to read on the internet, but I think maybe too much of it comes from a theoretical angle. So me and Trading 212, we thought, can we put together a series of videos that offer practical help to all the different aspects of trading? And when we're starting off today with probably what is the most important thing when it comes to trading, and something that does get ignored, I think, by lots of new traders. And it's the idea of how important trading psychology is to becoming a successful trader. If you've done any research at all, it's no secret that I think when most people start trading, most people end up losing money. And it can be really confusing, I think, for the new trader, because you think, well, hang on, all I need to do, if I can just get my charts right, get the right sort of indicators, then surely I'm going to have a successful strategy. And I think we all learn very quickly that maybe there's a bit more to it than that. And I think this is where the psychology comes in, because of course we all end up looking at the same charts, we get the same news, the same economic events during the day, but some people make money and other people lose money. So clearly, I think what goes on in our head is the thing that makes the difference between making and losing money in financial markets. I think there's been lots of research done, and one of the most common mistakes that we make in the beginning, and I think if we highlight these mistakes, if we know what they are, then hopefully we can avoid them in our own trading. But I think one of the more common mistakes that people make is their losses end up being quite a bit bigger than their winners. Now, this maybe won't be a surprise to you, and it's hopefully a relatively easy thing to fix. But if I just scribble some stuff on this pad here, let's take a typical trader who's right half the time. So we'll assume he's got almost a coin flipping approach to the market. And when the trader's right, the profit on the account is $50. Fine. But when the trader gets the market direction wrong, as we all do from time to time, the loss is $100. Now, you don't need a PhD in mathematics to figure out which way the trading account is going to go. Now, my background is technical analysis and charting. So to illustrate this, let's draw a chart of what the profit and loss is going to look like. So if our trader starts off with a winning trade, the trader's up $50. The next trade's a loser, of course, drags the account down. Then we see something of a bounce on the account, has a winning trade, up $50. The next trade is a losing trade, and so the whole thing goes on. So you can see a trend developing. So I think one of the reasons that there are plenty of traders find it such a challenge is because of this, the simple maths of their losses being bigger than their profits. So what we have to try and do is turn things around. There are lots of cliches in financial markets, and I think one of the maybe the better known ones is that markets are about hope and fear. This is what drives financial markets, but it also has, I think, a big impact on traders. Because one of the problems is, in this situation where our losses are bigger than our winners, when we have a losing trade, we're hoping it's going to stop and it's going to turn around and turn into a winner. And then when we have our winning trade, we're worried, we've got the fear that the market's going to take the profits away. So we have the classic situation where maybe new traders will snatch at profits really quickly, close the trade quickly as soon as it shows a profit, but then sit there on a losing trade and hope the market comes back. And what we have to do, clearly this is easier said than done. It's much easier to draw it on this pad than do it, but one thing we have to address is we have to flip that hope and fear part of the psychology in our mind. So when we have a trade that's going in our favour, we've clearly made the right decision for that part of the trade. and we should hope there are further profits to come. But when we have a market that's moving against us, that's not going the way we thought, we shouldn't sit there hoping it's going to come back. We should be sitting there a bit worried that we've got the market wrong and maybe it's time to take a small, manageable loss. So take a look at maybe your own trades. If you've only done demo trades so far, or maybe you've started trading, take a look and have a look at this breakdown between the average winning trade size, how much that makes you, and how much the average losing trade makes you. And if you see that your losses are bigger than your winners, then it's something you need to address. It's a really, really basic part of trading psychology, but hopefully, it's something that is easy to spot. So in this video, me and Trading 212, we've touched on how important the psychological aspects of trading are. We're going to cover this in a bit more depth, so make sure you watch the next 2 videos. And if there are any comments or any other topics you want us to cover, just leave us a message in the comments below.